Hello, everyone. I'm Lizette Gabriel, and I work as a librarian in the Business and Economics Department here at the Los Angeles Public Library. Before I start a presentation, I just want to say apologies if I lose my voice, but due to the situation here at the city and what everything everybody's going through, thank you all for the support and the emails and all the well wishes and whatever that's been going on that I've been seeing in social media for our colleagues and for the people of the cities that have been impacted by the fires. And now I want to head into our program, which we are hoping that as the new year starts, things will, God willing, be better. So today's presentation is called Building Your Financial Future. This program is brought to you by the Alliance for Economic Inclusion, and today's presenter is Michael Bailey. As the new year starts, have you thought about investing in your future with assets? What is an asset and how can it help you? Michael will discuss how to build assets that include buying a car, investing in your education, or enrolling in a training program. You will learn about the value and benefits of asset building and how they can help you reach your financial goals. If you have any questions during the presentation, please put them in the chat box or the comments box in your end, and we will answer them at the end of the presentation. This program is being recorded and will be available on the library's YouTube channel. Now I'd like to pass the presentation over to Michael.
Hi, thank you, Lizette. Today we're going to be discussing building assets for your financial future. Next slide, please. We will discuss what assets are, why assets are beneficial, how assets can help you build your financial future, and how you can develop a plan to build assets. Next slide, please. The key takeaway from this session is assets can lead to wealth and financial security. Next slide, please. So what is an asset? An asset is something you own that has value. For something to be an asset, you must own it, be able to control it, and be able to make decisions about it. For assets that are not money, you must be able to exchange them for money. As we talk about different types of assets, you can write down examples of each for your own notes. You may be thinking of things like a car or baseball cards. Some assets you can see and touch. These are called physical assets. But there's only one type of assets that can be financial assets. Some examples of financial assets are cash, money in checking accounts, savings accounts, and stocks and bonds. Some assets are intangible, are called productive assets. They are not physical or financial, but are still important. They help you produce more assets, often by earning money. Like, for example, investing in education and training to build your skills may help you find a higher paying job. With the additional earnings, you can save money. Others would be like tools that you can use to earn money, such as equipment for a lawn care business, or another example of a productive asset. Skills can be a productive asset. For example, being bilingual often opens up additional job opportunities. Credit reports and scores can also be productive assets because they can help you get other assets that require financing. An asset is determined based on the type of asset. So physical assets are valued based on their resale value, what you could sell them for, such as appraisal value for a house, or resale value for a car, or garage sale value for household items. Financial assets have an actual value, such as the balance in a checking account or savings account. Productive assets offer benefits that are generally not reflected in terms of dollars. For example, a credit report that enables you to get a favorable term on a loan is a productive asset. But the value of that asset is not defined by the amount of money. Next slide, please. All right, so benefits of asset building. An asset Asset building refers to strategies that increase the financial, physical, and productive assets you own. The strategies may increase the value of assets you already have or help acquire new assets. Being financially secure means you can take care of yourself and your family even if unexpected things were to happen. Financial security requires both income and assets. And so job losses, an accident or illness, the breakdown of your car, or needing to take an extended time off from work are examples of potentially unexpected events that require money. Assets provide a financial cushion to help you manage those unexpected events. So you can think of your assets as the foundation for your financial future. Assets are essential to achieving long-term financial stability and also growing wealth. Next slide, please. So owning assets. Owning assets creates a buffer to help you and your family handle emergencies and hardships. And so, as we mentioned earlier, a reduction in hours at work or job loss are examples of how your income could suddenly go down. A major illness or broken furnace can result in unexpected expenses. Assets can help you make it through those periods of financial need. It also helps you reach your goals. It is easier to further your education, buy a house, have income in retirement, or start a business when you already have assets. It also increases your options. And so assets provides you with options, more choices. And that could be for education, for healthcare, for where you live, for the size of a television, and for many other things in life. Assets help you earn more income and succeed in the job market. So owning a physical asset like a car can increase your income and job prospects. For example, you could accept a higher paying job even if it's further away from your home, or a job that is not accessible by public transit. Productive assets like education and skills can help you earn income also. And lastly, it inspires you to look to the future to make long-term plans. Having assets and a plan to build more assets can encourage you to meet your goals, think about the future, and motivate and help you plan for it. In addition, it also reduces stress for you and your family. It's been noted that households with at least $2,000 in assets, they can generally be converted to cash and help you to recover anytime if there is a unexpected event that happens in your life. Families who have assets feel less stress over financial issues. They know that they have something to fall back on, so it gives them a peace of mind. Many people pass their assets on to other family members, spreading the peace of mind. And so it could be through the form of a will, etc. Next slide, please. All right, so our key takeaway is assets can lead to financial security. So again, assets can lead to wealth and financial security. Next slide, please. All right, section 2, how assets create a financial foundation. So we will discuss the relationship among assets, liabilities, equity, and net worth. Next slide. So the key takeaway from this section is net worth is a good measure of your financial stability. So you calculate your net worth by subtracting your liabilities, money that you owe others, from your assets. Next slide, please. So to understand how assets create wealth, you need to understand how assets are related to liability and equity. And so an asset is something that you own that has value. To get assets, you sometimes need to borrow money. For example, to buy a house or to go to college, most people borrow money. A liability is something you owe others, usually money. So once you borrow money, you have a liability until you pay it back in full. Many assets, especially financial assets, do not create a liability. So you don't have to borrow money to build a savings account, to set aside money for goals, to create an emergency fund, to contribute to a retirement fund. You don't create a liability when you save in an educational fund or an ABLE account. Assets and liabilities are also related to equity. And so equity is the value of an asset minus the liability related to that asset. So you can think of in terms of it's the part of the asset that one would own outright. Let's see, next slide, please. So next we're going to talk about net worth. So net worth is a measure of someone's financial wealth. So net worth is your assets minus your liabilities. It is what you have left over after you pay all of your liabilities. So another way to think of your net worth is the equity from all of your assets added together. Next slide, please. All right, the value of your net worth. So your net worth can be a positive number, it could be 0, or a negative number. And so a positive net worth means the value of your assets covers all of your liabilities, and there still is some left over. This means you have a cushion for financial emergencies. It's good to have a positive net worth. A 0 net worth means your assets equals your liabilities. That means you do not have a financial cushion. And then a negative net worth means your liabilities are greater than your assets. And in that case, you also do not have a financial cushion. So, a question. Do you think you can determine if someone is economically secure just by knowing their income? And I can tell you that income alone is not enough to determine if someone has economic security. That income could be disrupted by the loss of a job or reduction in hours at work. Plus, you can't tell from income how much debt someone has. And you can't tell from income how much money someone has in savings accounts or the value of other assets that they own. Net worth, however, is a better indicator of financial health. So there are 3 steps to calculating net worth. And so we're going to cover those again. So step 1 is list financial and physical assets and their values. Once you've done that, you would add the values of those assets up to get your total assets. Productive assets are intangible, and we do not include them when calculating net worth. And so, for example, a productive asset would be being bilingual. And so you wouldn't be able to tally up the actual value of that asset to add in this calculation. Step 2, list liabilities and the amounts owed on them. Then add up all of those liabilities to get your total liabilities. And the last step 3, is to calculate your assets minus your total liabilities to get your net worth. All right, we're going to move to the next slide, please. So calculating your net worth. You can increase your net worth by increasing your assets or decreasing your liabilities, or both. As we talk about how, you can take notes how to increase your assets. After discussion, we will have an opportunity to kind of reflect on some changes in how to apply, I guess, in our own lives. So what are some specific ways people can increase their net worth? Next slide, please. So you could spend less than you make. This sounds simple, but it's tough. There are so many pressures to spend. People also refer to this as live within your means. If you spend less than you make, you can save money. Another way would be to buy less than you can afford. So when buying homes, cars, furniture, computers, and other things, buy less than you can actually afford. This provides flexibility and prevents you from becoming overstretched financially. Another way would be to save money. Build savings will help you save for emergencies and your other goals. Even saving small amounts of money on a regular basis can make a difference. Another way would be to participate in retirement savings programs. And so this is money you save in taxes. However, it does not mean that your take-home pay will decrease much. If your employer matches some of your contributions, try to save enough to get that full employer match. Not taking advantage of a match savings by your employer is almost like leaving money on the table. Self-employed people or small business owners, entrepreneurs also have options to save for retirement. You can use debt responsibly. So remember, using your credit card creates a liability, money that you owe others. As your liabilities increase, your net worth is going to decrease. Next would be to pay down your debts. As you pay down your debts, your total liabilities go down. As your liabilities decrease, your net worth increases. So less debt means a higher net worth. You can also explore public benefits. Benefits.gov is a good place to start. Using public benefits you're eligible for can increase the total amount of resources flowing into your household. Another way would be to claim tax credits. You may qualify for tax credits and a refund, and even if you do not owe taxes. And so when you're filing your tax return, going through it with your CPA, or you can reach out to a VITA center, which is a volunteer tax assistance center. You can contact the IRS or their website and find a VITA center. These are usually free resources, and they will help you file your income taxes based on your adjusted gross income. And also, you can bill by saving any refunds that you may get from your tax returns. Other ways would be to shop around. Shopping wisely can help you save money on products and services. This also includes financial services. And so if you're looking for a checking account, shopping around to find a financial institution that's going to offer low monthly fees can help you save money. Also, build more assets. Economic security means more assets and net worth. So you've already started on asset building by attending this training. So think about the next steps that you would take to continue to build assets. All right, next slide, please. All right. Our takeaway, remember, the key takeaway from this section is net worth is a good measure of your financial stability. So you calculate your net worth by subtracting your liabilities, which is, again, money that you owe others, from your assets. All right, next slide, please. All right, so cars as an asset. We will discuss how a car can be a productive asset and look at some key considerations when getting a car. Next slide. And so the key takeaway from this section is a car can be a productive asset when it helps you get other assets. So plan ahead to get a car you can afford with as little debt as possible. All right, next slide, please. Having safe and reliable transportation is an important part of financial security. It's also a key part of asset building strategies for many people. So people often think of owning a vehicle as the only form of transportation. A vehicle might not be necessary for some people, though, especially for people who live in areas that have good public transit options or can use a bicycle or other forms of transportation. However, for many people, not having a car or other vehicle can limit their options to earn income by limiting their choice of jobs and limiting their access to medical services, education, childcare, elder care, etc. So, question: does owning a car always make you better off financially? And I would say if the cost of buying and maintaining that vehicle outweigh the benefits, you are not all better off financially. Cars depreciate. And so the amount you can sell them for goes down over time. Next slide, please. All right. Next, we're going to look at how much car can you afford. There's no precise formula for determining how much money you can afford to pay for a car, but some guidelines and questions can help you estimate affordability. So start with your monthly spending and savings plan. Determine how much you can realistically afford to pay every month. And so remember that the monthly car payment will not be your only expense related to owning a car. So be sure to also include other costs for insurance, maintenance and repairs, gas and fuel, title and registration fees when you first purchase a car. So again, these additional costs may depend on whether you will buy or lease a car. Once you know how much you can afford to pay each month, you can use that dollar amount to get a good idea of the price range of a car that you can afford. If you need more information related to affordability and calculating affordability for a car, you can visit the Consumer Financial Protection Bureau website at www.cfpb.org or www.consumerfinance.gov. All right, next slide, please. All right, so tips for getting a car loan. So if you've determined that you want to finance your car, here are some tips on financing. So first, review your credit report well before you purchase the car. The last thing that you will want to do would be to go to a dealership and not know what's on your credit report. This also allows you to correct inaccuracies such as erroneous history of late payments, things of that nature. Fixing mistakes can also help save money on car insurance because generally, whenever you apply for car insurance, they're going to run a credit inquiry also related to that transaction. You can get free copies of your credit report from www.annualcreditreport.com. You're entitled to a free report from all three bureaus on at least a 12-month basis. Another step you can take is to get pre-approved for a loan from at least one financial institution before you go to the dealership. So a financial institution such as a bank or credit union where you already have an account, you may seek them out to see if they can provide you a good rate on a vehicle. And you would do this before you actually go shopping for a vehicle at a dealership. Another measure you can take is to don't share the interest rate that you get from that credit union with the dealer until you finalize the amount of the car and you're at a point that you're actually ready to purchase the vehicle. Next will be to shop around. You may be surprised by how much comparison shopping can actually save you money when purchasing an auto. Interest rates also matter. But so does other things like the term loan. The longer the term, the more interest you generally are going to pay. You'd also want to make sure that you keep good records of your loan quotes. And so when you're doing your comparisons, this will help you better understand which one is going to give you the better deal. An easy way to go through and analyze those would be looking at the annual percentage yield annual percentage rate or APR on the vehicle to help you determine which is going to be the better deal for you. Generally, the one with the better APR is going to be the better deal in the long run. Another tip would be to leave the vehicle at the dealership until the terms of the deal is finalized. And so if a dealer offers you a contingent or conditional loan agreement and lets you drive the car home, the terms of that loan could change and be less of an advantage to you. And so you want to make sure that the deal is finalized before you actually leave with the vehicle. All right, next slide, please. Closing. So a car can be a productive asset, as we noted earlier, when it helps you get other assets. You, again, want to make sure that you plan ahead to get a car that you can afford with as little debt as possible. Next slide, please. All right, training and education as assets. We will discuss how training and education can be productive assets. We'll also explore some key considerations for getting and paying for training and education. Next slide, please. And so the key takeaway from this section is training and education can be productive assets when they give you a strong chance of securing a better career or a path for a higher paying job. You want to make sure that you plan ahead to pay for them with as little debt as possible. Next slide, please. And so training equips you to perform a particular job or task. It has the potential to prepare you for a better career or higher paying job. And so many types and levels of education can prepare you for a better career or higher paying job, such as having a high school diploma or a GED, obtaining an associate's degree from a 2-year college, or a bachelor's degree from a 4-year college, or other forms of higher education. This training and education can be productive assets. Again, that's assets to help you get other assets. Getting an education leads to higher wages in most cases. This is a significant economic advantage over many years. Pursuing education and training can be very important for your asset building strategy and a smart investment toward meeting those financial goals. There are also many paths to higher paying jobs through having a good education and training. So, question: what are some types of educational experiences and education institutions that can help you get a new job or career? Next slide, please. So it would be on-the-job training. It could be apprenticeships, vocational, other career and technical schools, community colleges, four-year universities, the military, Job Corps, AmeriCorps, Peace Corps are all examples of ways in which you could gain educational experiences from institutions to help you get a new job or to further advance your career. Next slide, please. So like many assets, pursuing an education and training requires upfront and ongoing investments. You may need to invest your own money, resources, and time. And so many people also need to take on student loans in order to be able to finance or pay for this ongoing education or training. There's also an opportunity cost to pursuing training and education because the time spent in school may be time not spent earning money. And so stop and weigh that opportunity cost. Next slide, please. Sometimes training or education is not a smart investment. And so generally it is, but there are cases where it may not be an advantage for you. So you want to make sure that you research any school you're considering attending, its training programs, its record of job placements for graduates, and the cost before you agree to attend that college, university, training program, etc. This does not mean you shouldn't pursue training or education. It just means that you should make informed choices. All right, next slide, please. And so the price of pursuing training or education can vary greatly. There's usually an advertised or sticker price that assumes no financial aid or scholarships. This is not what many students actually pay. And so there are options for paying for training and education. Some of those options include you could ask family members or friends for help. You could save money now or use money that you've already saved. Working while attending school, applying for scholarships and grants, asking your employer to cover some or all of the cost. It's worth checking with your employer to see if you have this option and what your employer may require of you in return. Also, borrowing the money using student loans. Many people pay for training and education with a combination of the strategies I just mentioned. Next slide, please. All right, scholarships and grants. And so most scholarships are merit-based. So this means they are awarded to students with certain qualities, such as proven academic or athletic abilities. And so many scholarships have rules you must follow, applying by a certain date or maintaining a certain GPA, for example, or some of the qualifications that you would need to meet in order to qualify for those grants or scholarships. You also compete for scholarships with other students who have applied for them. So it wouldn't just be yourself. You're generally competing with a lot of other students. And the grantor is going to go through and review all the information related to the person that's applying and then try to make a determination of who would be better suited for the scholarship. Most grants are needs-based. And so this means they are awarded based on financial need, although they can still be competitive. So again, scholarships generally merit-based, whereas your grants are more needs-based. However, some could also have merit tied to it. Next slide, please. Saving money for training or education. And so some people choose to save money for education. And so there are special savings accounts and programs to help you save money for education. And so one of those would be like a 529 plan. And so these plans are designed to help families save money for future education costs. Contributions to a 529 plan go into an investment account that's managed by a plans fund manager. Funds from that 529 savings plan can be used to pay for qualified education expenses. The rules will vary by your state. And so you want to make sure that you look at what the plan will cover before making that investment. So is it going to cover tuition only? Is it going to cover tuition and housing? Is it going to cover books, etc.? There's also ABLE accounts. These are tax advantage savings accounts for individuals of any age with significant disabilities that begun before their 26th birthday. And so individuals with ABLE accounts can use the funds for qualified disability expenses, one of which is education. For both 529 plans and ABLE accounts, start by looking at the 529 and 529A plans sponsored by your state. Typically with cost and tax benefits for residents, and compare them with plan options from other states. Next slide, please. Another form of financing education would be student loans. And so there are two major categories of student loans. There's federal student loans and there's private student loans. We're going to discuss federal student loans. Private student loans are non-federal loans offered by lenders such as a bank, a credit union, state agency, or school. So wondering how much to borrow? Remember that you don't have to borrow the maximum amount of money that's offered to you just because you're able to obtain the loan. You want to try to limit your borrowing to the money that you need for your education expenses only. As a rough estimate, try not to accumulate more debt than you expect to earn when you are starting your first job after this technical school or college or whatever program that you're entering into. Next slide, please. Federal student loans are offered by the federal government. A company under contract with the federal government may service the loans. And so federal student loans allow students and their parents to borrow money to help pay for college, career, vocational schools, and then also for grad school. They usually have lower interest rates and offer more flexible repayment terms and options than private loans that are, again, offered by banks, credit unions, etc. And so generally, repayment of a federal loan does not begin until after the student leaves school. Federal student loans can be used to pay for school expenses such as tuition and fees, room and board, books, computers and tablets, other supplies, transportation, etc. Loan funds are provided to you through your school. Next slide, please. Your FAFSA, so complete a FAFSA, FAFSA to be considered for federal loans, work study programs and grants. You can go to the government site, afsa.gov, or their mobile app to apply. You want to make sure that you're familiar with the site, familiar with the deadlines, the application, etc., so that you can apply early. Carefully review the student aid report and respond immediately to any requests that you may receive from FAFSA related to your student loan. Next slide, please. And so paying back student loans. If you give me just a second. And so it's important to pay them back on time because this will affect your credit, which is a productive asset. And so you want to make sure that you are timely in your payments for your student loans. Unlike other loans, federal student loans are not automatically discharged due to bankruptcy. Borrowers who fail to pay their student loans could be referred to debt collection agencies, experience a drop in their credit scores, which would make credit more expensive and perhaps make it harder to find a job, and have a portion of their wages withheld, which is called a garnishment. So before taking a student loan, make sure you understand the terms of the loan before you actually sign on the dotted line for that loan, including your options for repayment. Next slide, please. If you find that you cannot repay your federal student loans according to the original terms that were agreed, you want to make sure that you contact the servicer of that loan right away. You may have some options. For example, you may be able to restructure your monthly payments to be more in line with your current income. For more information on that, you can go to www.studentaid.gov. Next slide, please. So our key takeaway from this module was training and education can be productive assets when they give you a strong chance of securing a better career or higher paying job. You also want to make sure that you plan ahead for them so that you incur as little debt as possible. Next slide, please. All right, so now action plans. And so what will I do? How will I do it? Will I share my plans with anyone? And if so, who? So these are all things that you should be considering as a result of attending this training session. I would say before you leave, you will want to make sure that you fully understand, I would say, the content and do your own research as it relates to a lot of the information that we have discussed in building your financial future. I think it will help you in the long run to achieve your financial goals. But again, as notes here, share any plans that you may have with others, and that may help you build on that to create a more solid plan and also hold you accountable to your plan. And so, with that, I am going to turn it back over to Lizette for questions.
Yes. All right. Thank you, Michael. So based on the fact that we are done with our presentation, let me see if there are any questions from the audience. I see a few hellos. So thank you, everyone, for those of you who participated during the program. And let me see if we have any questions. Okay. So we have one right now. And here's the question. How do my assets help during a financial or natural disaster?
Very good question. And so if you have funds that are saved, let's say, for example, if it is a financial asset, which would be like money in a savings account, or it could be money in a 401k, generally, you can tap those resources right away. And so the ability of you to find housing, let's say, for example, if your housing is no longer available and you need to get a hotel or temporary housing, you actually have the immediate funds to be able to do that. Another example would be thinking a little bit more, not, I would say, immediate, but maybe within the next, I don't know, month after a natural disaster, you may need more funds than what's in your savings account. And so generally, a lot of 401k plan administrators will allow you to do a hardship withdrawal from that plan. And then you can use those funds to try to help recover. And so again, having those resources definitely gives you options versus if not, then you're more or less dependent on any type of, could be state or federal assistance, and then you're waiting on them. So.
Okay. When you do a hardship withdrawal, or I guess if you use it for a hardship, are you charged any of the penalties for the taxes?
So generally, depending on the hardship, they will waive the penalties, but you're still responsible for any taxes, federal income taxes that are due on that. Okay. And so that part is actually not waived.
Okay, it's good to know. All right, so then the next question that we see here is there an age limit for the 529 plan?
Very good question. There is not an age limit for the 529 plan. And so anyone could be enrolled in a 529 plan.
Okay, perfect. Let's see, because I know those of who might be interested in going back to school but don't have the means yet, you can start sort of saving, as you've mentioned throughout the presentation. So that's a good one. And then the other question that I see popping up is wait, no, I think we already did that. No, we haven't. Sorry. The question is the physical versus financial assets. Hopefully some of you who have been throughout the presentation kind of remember what they were. So which ones are the best ones to have?
And that is another very, very good question. And there's not technically a right or wrong answer. It depends on the asset and how you're evaluating the asset. So for example, a physical asset could be a home, and a financial asset may be a money that you have in the stock market or that you've invested in stocks. And so generally, if it is a home, it will appreciate in value. It may not appreciate as fast as maybe your financial assets. But then again, it just depends on the market. Some markets have a higher demand, which is going to push up the cost of housing prices. And so really it just depends on the asset itself. What I would recommend is trying to have a diversified set of assets. So not just physical assets, but also have a multitude, so physical, productive, and financial assets.
Okay, that's great. Actually, that's great advice, because I know some people tend to have only stock and bonds, but they forget about the other type of assets that they can sort of diversify into. All right. So we are a little early with our time, yet I don't see any more questions from our public. So if that is the case, then thank you all. Thank you especially, Michael, for being with us today and for sharing the valuable information throughout the program. So hopefully some of you have ideas as to your assets, what you do and don't have, and again, diversifying, and keep those in mind during times of hardship, for example, what we're going through today, or in any other type of natural disaster, or even personal ones that might impact you in some small way, but still make that financial impact. So I also want to mention that some of the information or the grants that Michael mentioned, in case you need information on resources and how to find the library does have, we have directories for individual grants, and we have a database called Candid that can help you find grants both for individuals, those of you who are either in small businesses or nonprofits who want to find some sort of grants from those grant makers. So it's a great database, but it's only available at the central library. Everything else we can help you with and assist you with remotely. But again, that one is specifically only central. And now I will repeat this part. If you were not able to attend the program from the start, please be aware that it is being recorded. And as soon as we end the stream, you can watch it on the library's YouTube channel. So I'm going to check again in case any other questions. I don't see any.
Lizette, can I
Yes.
just mention one thing, I guess, since we have a little bit of extra time, and
Yeah.
that would just be the importance of the credit report. So again, that is a productive asset, an asset that could be used to help you earn or make or increase the amount of assets you have, increase your net worth. Just stressing the importance of the credit report. I know a lot of people will focus on the score itself, which is important, but really you want to make sure that you are reviewing your credit report on a frequent basis, especially due to the nature of fraud that's happening across the country, across the world right now. And so just being aware of what's actually on your credit report, and then following up with any inaccuracies with the reporting bureaus. And so submitting notification of inaccurate information to the bureaus to have them go through and change it, or there may be something that's on there that you may not recognize. The same thing, you would submit a request or inquiry to the credit bureau and wait for that creditor then to respond back with information related to that item. But it's so intertwined in all facets of life. So employment, a lot of employers will go through and pull credit reports. If it's car insurance, they're going to pull a credit report. If it's homeowners insurance, they're going to pull a credit report. And so it's something that's just very common. If you want a credit card, and generally they're going to pull a credit report. And so just making sure that that information is accurate. So when you do apply for any of those items, the likelihood of you getting approved or getting lower rates or being charged lower because the information on there is positive is going to be the key to building financial wealth.
Okay, that's actually great advice. And I know we have other programs that go into more detail with the credit reports. But just a quick question for you offhand. So if I remember reading correctly, did Biden now somehow, I think he signed something that would increase our scores? Is that something that we will see right away, or
I would say, and so it's dealing with removing medical debt from the credit reports. And so I would say something that we probably will see within the next 12 months, I'm assuming. So generally after the bill's passed and it goes into effect, and then it has to be assigned to a regulatory agency, and they will go through and prescribe rules around that. So I'm thinking within the next 12 months or so.
Okay. So yeah, so keep that in mind. If you were thinking that your score might go up right away, it's gonna take a little while. Any other tips of information that we should be aware of that are related to the asset part besides the credit report, or?
Mainly just keeping track of your finances. A lot of people don't actually, for example, balance their checkbook. Just looking to see what's coming in and what's going out of your account, and actually sitting down and looking at the flow. And so just taking your bank statement or looking at your transactions for a 30-day period and see how much money actually came in compared to what went out. And for a lot of people, it can be surprising because it's different if I were just using my debit card and swiping, and I know that there's money in my account. I just swipe and go, swipe and go. But does it really give me a good picture of my finances? And I would say in most cases, it does not. And yeah, so just understanding what's coming in and going out will help you be able to save money.
Yes.
One thing that I see a lot of time with customers would be they come in, they want to save money. And so they have not sat down and done a budget, so they don't know what's coming in and going out. But they'll still put money in let's say, for example, and they'll have money swept into their savings account on a monthly basis. And so it could be $100 every single month or $200. But even though that money is going in there, on the flip side, a lot of them can't afford it. And so what happens is they end up using credit cards to compensate. And so then you're incurring debt when generally you wouldn't have to, because now you're paying finance charges on that amount that you're using that credit card for, when you have money that's in your savings account that you could actually use to offset that and not actually incur that debt. So understanding how much you can actually save. But again, if you don't go through that process of understanding what your inflows versus outflows are, you can get trapped in that cycle.
Yeah, and they'll throw you off too. I just want to say to that, if for those of you who are not used to writing down your budget or don't care to use some sort of tool, there are Excel sheets out there. I know there are apps that can help you just put your information. I'm old school, so I technically have this little piece of paper. I put how much I spend, and then I start deducting. So I do keep it in my wallet. So I know it's a little tip for those of you who may not want to deal with another app. Doing old school helps just as well, as long as you keep track of all your expenses, and that way you can see what's left on your account. Hopefully it's a little bit more than mine usually is. But yeah, so that's one of my little tips for those of you who decide you still want to use pen and paper. We are good to go now, and we are close to our hour. So again, I'm going to double check our comments just in case. And there are no questions for my public, so I think we are technically now officially done. So again, thank you again, Michael. Thank you again to all our participants who are with us today. And remember, it will be uploaded as soon as we end the live stream. So if you want to, impart this all this knowledge to your friends, just to let them know, go to the library's YouTube channel, which, by the way, I should just quickly put up so you know where it is. There you go. And just look at our videos section and you'll see it right there. So again, thank you, everybody. Have a safe afternoon wherever you are, and come and visit our programs for the future again. All right. And thank you, Michael.
Thanks. Take care.
Yeah, take care.